Hey, YouTube family, and welcome to another edition of the Kevin Strong Show, aka Homies and Homettes. Welcome. So, in this video, we're going to talk about how the housing market is starting to melt down. I'm going to show you some information, a lot of graphs in this particular video, but more importantly, there's going to be one section of the video that talks about if you adjust housing prices for inflation, not nominal, for inflation, there is a possibility that housing prices could revert back to 2012 adjusted for inflation. So if you're enjoying this type of content, please do me the honor of smashing that like button, commenting, and share because I care. So without further ado, I'm going to get ready to jump into this article here and give you my little editorial comments throughout it. And more importantly, Happy New Year's. I hope you guys have made some great New Year's resolutions. Mine is to continue to help people in the area of mortgage consulting, loan modification. That business is really starting to pick up for us. Full disclosure, I am a licensed real estate agent and a licensed mortgage loan officer. So without further ado, let's go ahead and jump into this here and let me see if I can share my screen. There we go. Okay, so I'm going to jump up to the title of this article, and it's called "We're in the Second Biggest Home Price Correction of the Post WW2 era." And it's some really interesting information in this article. This article came out December 28th of 2022. Excuse me, by Lance Lambert. No jokes with that name, but we'll figure out something along the way. So I'm going to pull back down here, and I've got this first part that I really wanted to read to you guys, and that's why it's highlighted to kind of bring attention to it. For 124 consecutive months, right? Over 10 years, spanning the bottom of the previous bust in February of 2012 to the top of the pandemic housing boom in June of 2022. The seasonally adjusted Case-Shiller National Home Price Index reported positive home price growth, okay, for almost a decade. Now we're in a new streak, 4 consecutive months of U.S. home price declines. Let me go ahead and, sorry, I had right here. Okay, so that might seem to some of you guys on the surface as kind of like a small deal, but it's actually a big deal because housing and real estate in aggregate or as an entity moves very slowly. It moves in quarters and it moves in years. It doesn't change like the stock market could go down 10%, in a week. That's not how real estate works. Another analogy would pretty much be like you have a semi truck, 16 wheelers, and it's fully loaded and it's going down a hill at 80 miles an hour. Then all of a sudden it has to stop. It's going to take quite some time before that vehicle with all that momentum and inertia behind it for it to rest. Okay. So just pretty much keep that in your mindset as we go through this article, because it's very telling and it's painting an ominous picture that real estate is going to continue to capitulate from a price and value standpoint for the foreseeable future, despite some of the experts who feel that the Fed is going to pivot. The last time the Fed did some serious rate cuts back in 2008, that did not save housing. Housing prices and values continue to go down for about 4 consecutive years. And in aggregate, around 2012 on a national level, that's when we started to come out of the real estate, basically recession, and home prices started to go up. Specifically, that's when the Seattle market took off. So let's go ahead and take a look at this first article. Like I was just kind of teeing this up. U.S. home prices are falling for the first time since 2012. This is a big deal because without me getting into the weeds here, the last time you've seen home prices falling, what's here? The red is bad, the blue is good for simple math. If you go back, that really screams out, or what should scream out at you guys, is that there's long periods of time of growth. And then when it hits hard, and it hits for several years. It doesn't turn around in 6 or 12 or 18 months. I mean, I don't have this thing right here, but if I had to guess, this is probably like the late 80s, all the way to like 92 here. And then it probably popped up a little bit. And obviously we knew what happened here. This started around 2006, as you can see. And we didn't come out of that funk truly to around 2012. Okay, so this was 1990 here, and then we started to go positive about 1992, 92. So that was 2 years. This one obviously took 4 years, and here we go. So this is very, very ominous. So think about that analogy where I told you guys about the tractor trailer, fully loaded, 16 wheelers racing down a decline, and it's not going to be able to stop on a dime. So anybody who bought a home within the last 2 years, especially in some of these areas that just went crazy within the last 2 years, and we're going to talk about that. Places like Seattle, San Diego, places on the West Coast, California, specifically San Francisco, those home prices are coming down at a very, very rapid rate, and they are set up for a significant pullback in terms of price and or value. So I thought that was an interesting chart. Once again, please keep that in mind. The last time we've had something negative in terms of home prices falling, it has been 10 years. And as you can see, based on this chart, this is something that does not turn around in 6 to 12 months. So let's take a closer look at a hypothetical drops in U.S. home prices. That's basically what this graph talks about. I'm going to go back to, once again, 2008. As you can see here, we had a big, big dip, right? And we didn't come out of it until, once again, here you go, around 2012. So most of you guys, regardless what market that you're in, probably seeing significant increases in home price and value within the last 10 years. I think Seattle has gone up around 93% in 10 years. My math may be off a little bit. It might actually be a little bit more than that. In some areas, there's places that has actually doubled in value in 10 years. That's no longer the case now, but if they sold at the peak, you know, they have probably captured some really, really, really good nominal equity, not equity adjusted for inflation, nominal equity. But getting back here to the charts, as you can see here, this all started to take off when the government intervened in 2008 for quantitative easing, and has artificially been pushing up not only the stock market as an asset bubble class, but also home values as well. And this is what this illustrates. And then within the last 2 years, post the healthcare crisis, it really, really shot up. So now, as you can see to the right of this chart, this thing is finally starting to spill over, or turn over, as they say. And this may sound like a little dip, but if you can see here from a peak to a dip, you don't see that anywhere along this graph. The only time you see a little bit of a significant dip, right? This is a significant dip. You have to go back to what? Wow, look at that. Here again, we're talking about 2007 to 2008. No, I'm not inferring that this is going to be as bad as 2008. I think in some areas it possibly will when you factor in adjusting for inflation. But in terms of nominal prices, real prices coming down, they may settle out around 2018, 2017 in areas like Seattle and on the West Coast. But there is a possibility when you factor in inflation, it can come down much, much more. So once again, this is a very, very ominous sign that the housing has more pain to come than anything else. Pandemic housing boom gains are deflating. So let's talk about what that means. Between March of 2020 and June of 2022, U.S. home prices spiked 41.3% within the last 2 years. This is why I'm saying anybody that has purchased a home within the last 2 years that probably went 5-10% down or even less, FHA 3.5% down, VA no money down, which is a great program for leverage if you catch the market at the right time. But all of those basically examples of low down payment mortgage products are turning out to be negative equity right now as home values are starting to pull back. But the 2.35% drop in home prices between June and October has erased some of the gains, 3.3. It sounds, once again, like a small amount, but once again, real estate moves in quarters and years. So anytime you start to get a negative trend, that typically leads to a lot more pain. There's another article here that talks about shifts in home prices since their prospective 2002 peak. So this article or this particular graph is basically saying what's happened in certain markets since the peak. And the darker the circle, the more pain that particular housing market has experienced. So if you look at Seattle over here, 10%, that's a big deal. Keep in mind, most people who are putting 3, 5, and no money down, I've talked about this in my last video, are probably already upside down in their home because you typically pay 6% if you need to sell it to a real estate agent and another 2 to 3% for closing costs. So I'm just rounding off all of that cost as 10%. So you need to put 10% down when you first buy the house just to break even. That's assuming that you purchase the house for fair market value. As most of you know, there's a lot of people within the last 2 years that paid well over the asking price because everybody was FOMOing into housing, fear of missing out. So these numbers are much, much more ominous than what the data is showing. And these numbers are here. These are nominal numbers. These are real price numbers. These numbers are not factoring in inflation. Most of us do not believe that the CPI print of recent of 7.1% is really accurate. Most of us think inflation is probably somewhere around 15 to 20%. So if you adjust home price declines and factor in inflation just for 2022, this 10% is what? 25%? You see where I'm going with this? Very, very ominous. San Francisco down 11.2%, Portland down 4.9%, San Diego 7.2%, Denver down 5%, big deal. Dallas down 4.6%. Let's go over here. My stomping ground, Cleveland. Cleveland's a really, really interesting market. It normally gets hit a lot because there's a lot of economic and social disadvantaged communities, but you can cash flow quite well there. So areas like Cleveland and Detroit may not do as bad when this housing thing starts to implode. They may not go down that much in value because typically investors migrate to that particular area for cash flow and they don't expect appreciation. Appreciation is all on the West Coast. And that's typically where you're going to get hit. And let's round this up with Tampa down 2% and Miami down 1.9%. So here's something else. Shift in home prices between March 20 and October of 2022. Look at Seattle, went up almost 37%. This is unsustainable, guys. This is why I've been on record for a long time saying these hot markets are going to come down and they're going to come down fast. Just like when Popeyes comes out with a fresh chicken sandwich. Everybody knows about it. So all jokes aside, though, you've got Seattle down 36.94%. You've got Portland down went up 31%. Seattle went up 36%. San Francisco, 26%. 41% in 2 years in Las Vegas. Los Angeles, 34%. Let's go a little bit here on Cleveland. See, Cleveland went up 32%. Everything was just in a bubble. 45% in Atlanta. Miami went up 60%. 60%, folks, from March to October. March of 2020 to October of 2022 in less than 24 months. Miami went up 60%. So this is really, really an interesting time in the real estate market. I hope you guys have got a lot of value out of that. There's a lot of data that's clearly showing there is more pain to come. In my humble opinion, as an investor, can you always make money in real estate? Absolutely. But there's even some big, big dogs. I always screw his name up. Ken McElroy. He has about 10,000 units and about $1.5 billion under management. And he just recently did a video talking about pencil down. He's basically not buying real estate in 2023. So once again, this is a very, very polarizing topic. There's big money that says that you always buy. And there's a lot of big money that says, nope, there is a better entry point. From a retail perspective, I really believe that you're probably better suited being on the sideline and waiting for a better entry point. And if you had a situation where you're overextended with your debt and you can't seem to get out of it, you may want to consult the advice of a bankruptcy attorney and contemplate that. I know that's not something people want to do, but heck, in 2 years, you can qualify for an FHA mortgage in 2 years. And in 2 years, I don't think this housing situation in aggregate is going to be moving up anytime soon. So if you have to take your pain, you might want to take it now, right? It's like back during those cowboy days, we see the guy that got shot and then the doctor said, "Hey, Buford, you got shot." He said, "I know. Doc says that it's either my life or my leg, and he tells him to bite down on that stick, and he's like, shit, I wanted to take LaQuisha for a walk along the lake next week. He's like, LaQuisha? He's like, well, hell, even cowboys get jungle fever once in a while. So anyway, I hope you enjoyed this video. You know my motto, keep your credit score up and your debt down. If you're enjoying this type of content, please do me the like button, sending me a comment. I will respond to your comment, share because I care. Once again, Happy New Year's to all. Please be safe and have a responsible day if you are out driving and having a good time. And I'll see you guys in the next video.